Today, we're diving into one of the most powerful, yet often hidden, forces shaping the crypto markets right now. This massive wave of institutional investors who are snapping up Bitcoin right before the halving.
It's a really interesting pattern when you look at it. While a lot of retail investors tend to wait for the hype for the big market peaks, the world's largest financial institutions are already quietly getting into position. See, they don't chase the market, they get way ahead of it. So, let's pull back the curtain and decode their strategy.
All right, here's how we're going to break it all down. First, we'll look at the historical pre-halving pattern. This has happened before. Then, we'll zero in on the major players in today's institutional wave. After that, we'll unpack the economics of what's being called the Great Supply Shock. And finally, we'll get into why this cycle is just fundamentally different.
Okay, first up, the pre-halving pattern. You've heard the saying that history doesn't repeat, but it often rhymes. Well, in Bitcoin's world, the rhythm right before a halving is honestly remarkably consistent.
This whole phase has a name, the pre-halving accumulation zone. So what on earth does that mean? Well, basically, the wild price swings kind of chill out, the biggest players, the whales, start buying up more Bitcoin, and big money from institutions starts flowing in, but quietly, without a lot of fanfare. It's like the calm before the storm.
And look, this is not some new theory. We can see it plain as day looking back. Before the 2016 halving, accumulation started picking up about 6 months out. Fast forward to 2020, and we saw those pioneering companies like MicroStrategy and Tesla making their huge bets. And now, leading into 2024, we've got the launch of spot ETFs, which has triggered an unbelievable accumulation by major funds. The pattern is there, but the scale is just exploding.
And this quote, it just hits the nail on the head. It perfectly explains the difference in mindset. Institutions don't get FOMO, that fear of missing out. Their moves are calculated, they're strategic, and they are playing the long game. They are not reacting to hype, they're positioning themselves for predictable, built-in changes to the market, like the halving.
So that's the history. But how does this pattern translate to what's happening today? Who exactly are these big players gobbling up Bitcoin as we speak?
This slide really puts the evolution into perspective. Back in 2020, the big story was about a few bold companies, pioneers, adding Bitcoin to their balance sheets. And that was huge at the time. But 2024, we're talking about the very bedrock of mainstream finance. BlackRock, Fidelity, we're even hearing about sovereign wealth funds. The scale has jumped from individual corporate treasuries to the entire global financial infrastructure. Think about that for a second.
And the list of buyers today reads like a who's who of global finance. You've got the new spot ETFs, of course, which are a massive driver. You have hedge funds that are literally shifting capital away from traditional assets like gold. You've got sovereign wealth funds getting in on the action, more public companies following that same playbook, and all these massive clients being onboarded behind the scenes by custodians like Coinbase.
Which, of course, brings us to the most important question of all. We know who is buying, but why? Why are these traditionally conservative, slow-moving financial giants suddenly piling into Bitcoin in such a huge way?
Well, it's not just one thing. There are a bunch of reasons. They see it as a hedge against inflation, a way to protect their capital's purchasing power. That whole digital gold story, it's not just a story anymore, it's a core thesis for many of them. Its performance, it speaks for itself. It's outperformed pretty much every other major asset. And critically, as the market gets bigger, the liquidity is growing, and the regulatory picture is finally starting to get a lot clearer.
So what's the bottom line here? It's simple. We are watching Bitcoin graduate. It's moving away from being seen as just some speculative bet and is now being woven into global financial strategy as a legitimate macro asset class.
Now, all of this institutional demand creates this absolutely fascinating economic setup, which brings us to our next section, the Great Supply Shock. And this, my friends, is where things get really interesting.
I want you to picture two powerful forces on a collision course. On one side, you have institutional demand that is just skyrocketing, mostly because of these new, easy-to-use financial products like ETFs. On the other side, you have the fundamental code of Bitcoin itself, which is about to automatically cut the new supply in half. Soaring demand meets a shrinking supply. Basic economics, right?
And check this out. This isn't some hypothetical about the future. This is happening right now. Look at this chart. Even before the halving actually happens, the daily demand from just the spot ETFs is already absorbing way more Bitcoin than is being mined each day. That is a profound and immediate imbalance.
And that is the absolute key. Demand is already outpacing supply.
Smart money sees this. They get it. They understand that when you have a supply deficit that's about to get twice as severe overnight, the time to get in position is now, not after the event has already happened.
Okay, so all of this leads us to our final and maybe most critical section. We've seen the historical playbook. We see the insane demand right now, but there are 3 game-changing factors that make this cycle fundamentally different from anything we have ever seen before.
Number 1, the infrastructure is finally here. For the very first time, anyone with a regular brokerage account can get exposure to Bitcoin just as easily as buying a share of Apple. This just demolishes the technical barriers and unlocks a potential tidal wave of capital from everyone.
Second, the rules are getting clearer. That regulatory fog that has hung over crypto for years, it's starting to lift in major hubs like the US, Europe, and Asia. And what that does is it de-risks the asset for the big conservative funds that absolutely need regulatory certainty before they can even think about investing.
And third, as we've already touched on, Bitcoin is now part of the global macro conversation. It's being analyzed and discussed right alongside gold, equities, and interest rates. It's playing in the major leagues now.
So, when you put those 3 things together, unprecedented access, clearer rules, and macro relevance, you get a really powerful conclusion. This isn't just another 4-year cycle. This is the moment Bitcoin plugs directly into the engine of mainstream finance.
So let's just quickly recap what we've covered. 1, institutions or smart money strategically buy during this quiet pre-halving zone. 2, these new ETFs are creating a demand shock that is already way bigger than the new supply. And 3, this cycle is a whole new ballgame thanks to new access, clear rules, and Bitcoin's new status as a macro asset. And all of that leaves us with one final, very thought-provoking question. We're already seeing what happens when demand is greater than supply. So what happens next when that supply of new Bitcoin is suddenly and permanently cut in half? That is the multi-trillion-dollar question shaping this entire market right now.
This is DeFi Evolving. Visit Web3 Newswire for more updates on Web3 projects. Link is in the bio.